Hey everyone, welcome to today's Explainer. If you're a tax professional, a chartered accountant, a CA student, or even a business owner, you are in the exact right place. Today we are going to completely decode Section 154 of the new Income Tax Act 2025. We've got a lot of critical ground to cover regarding the new statutory framework, so let's jump right in. So, how does the new Income Tax Act actually support taxpayers with disabilities? You know the drill. Historically, claiming medical deductions meant chasing down every single pharmacy receipt, tracking nursing costs, and basically dealing with an absolute administrative nightmare. It's tough on the clients who are already managing so much. But under the new framework, Section 154 steps in as the definitive statutory solution to cut through all that compliance friction. Here is our agenda for today. We'll start with an introduction to Section 154. Then we'll decode the legal provision itself. After that, we'll walk through a practical tax example, look at compliance and Form 30, discuss some common practical issues, and wrap it all up with a summary and key takeaways. Section 1. Introduction to Section 154. All right, so what exactly is Section 154 of the Income Tax Act 2025? Simply put, it's a dedicated provision allowing a resident individual to claim a flat deduction from their total income. The key requirement here, they must be certified by a medical authority as a person with a disability. Notice a couple of vital things. First, it certainly applies to resident individuals claiming the benefit for themselves. And second, that magic phrase, flat deduction. You don't have to prove actual rupee-for-rupee expenditure. The medical certificate itself is what triggers the eligibility. It really streamlines the whole process. Section 2. Decoding the legal provision. Now, if you're comparing the old regime to the new one, Section 154 is the direct replacement for the good old Section 80OU of the 1961 Act. The core intent of the legislation hasn't changed at all. What has changed, though, is the structural clarity. The 2025 Act strips away all those obsolete explanations and lays out the conditions in a much more reader-friendly way. Basically, it's designed to drastically reduce interpretational disputes with the department. And here is how the numbers shake out. The law gives us two distinct deduction slabs, and it's entirely based on the severity of the condition. For a person with a standard disability, you're looking at a flat deduction of 75,000 rupees. But if that condition is classified as a severe disability, which means the impairment is assessed at 80% or more, boom, that flat deduction jumps up to 1,25,000 rupees. So what are the key elements to actually trigger Section 154? First off, the taxpayer has got to be a resident individual in India, no exceptions. Second, you absolutely need a valid certificate from a recognized medical authority. Third, the law explicitly lists the covered conditions, like autism, cerebral palsy, and multiple disabilities. And lastly, remember that Section 154 works hand in hand with Section 127 of the 2025 Act. Section 127 is where you'll find the strict legal definitions for things like medical authority and severe disability. Section 3, a practical tax example. Okay, let's put this into practice and see how it actually works on the ground. Step 1. Imagine your client, a resident taxpayer, gets evaluated by a medical board and receives a certificate stating they have an 85% severe disability. Step 2, as the tax professional, you identify the correct deduction slab. Since 85% is well above that 80% threshold, this clearly falls into the severe category. Step 3. When you are prepping their return for the tax year, you claim this flat deduction directly against their gross total income. And what's the magic number here? 1,25,000 rupees. Because of that 85% assessment, your client is legally entitled to the absolute maximum statutory deduction. You don't need a shoebox full of hospital bills or pharmacy receipts to claim this. That valid medical certificate is literally all you need to unlock the benefit. Section 4. Compliance and Form 30. But here's the catch. Understanding the law is only half the battle. The compliance landscape has completely shifted. Back in the day, under the 1961 Act, we all used Form 10IA under Rule 11A. Well, say goodbye to that. Under the new regime, you need to map this directly to the new Form 30, which is governed by Rule 61 of the Income Tax Rules 2026. If you or your firm try filing the old Form 10IA for tax years starting April 1, 2026 or later, your claim is going to be defective. Form 30 is the new standard. Let's look at the Form 30 filing checklist, straight from the official guidance notes. First, you'll fill in the basic assessee and patient details on the portal. Now, this next part is absolutely crucial. You have to upload a scanned PDF of Part B of Form 30, and it must be physically or digitally verified and signed by the medical authority. Next, file Form 30 electronically alongside the return of income under Section 263. Finally, secure the whole thing by e-verifying using a digital signature certificate or Aadhaar authentication. Section 5. Common Practical Issues. Now, let's talk about audit traps because we see these common mistakes all the time. Mistake number 1, filing the claim without Form 30. The solution is super simple. Form 30 is mandatory and has to be filed alongside the return of income. Mistake number 2, using an expired certificate. If the certificate says the disability is temporary, you have to get a reassessment when it expires. And mistake number 3, mixing up Section 127 with Section 154. Just remember, 127 is for money spent on a disabled dependent, while 154 is claimed by the disabled taxpayer for themselves. I really need to highlight this warning because it trips up so many professionals. Red alert here. If a medical board marks a disability as temporary and slaps an expiry date on that certificate, your deduction stops the exact moment that tax year ends. The FAQs and the Act are crystal clear on this. No deduction is allowed in succeeding tax years unless the patient goes back, gets reassessed, and you furnish a brand new medical certificate. Do not rely on expired documents. Section 6. Summary and Key Takeaways. Let's wrap this up with your 5 key takeaways. 1. Section 154 of the 2025 Act is your direct replacement for Section 80U. 2. You've got flat deductions of 75,000 rupees for standard disability and 1,25,000 rupees for severe disability. 3. Rule 61 of the Income Tax Rules 2026 is your new compliance Bible. 4. Form 30 is non-negotiable and must be filed electronically with the return. And 5. Always double-check those medical certificate expiry dates to avoid having your deduction invalidated. So as we transition to the 2025 Act, you've got to ask yourself, are your clients' historical medical files fully compliant with the new Form 30 requirements today, or are you sitting on an audit time bomb? Thank you for watching. Please like, subscribe, and share. This video is for educational purposes only and does not constitute professional advice. Tax laws are subject to amendments. Please consult your professional advisor before taking any action. This is an AI-generated educational video.